Before we get into stock-specific issues, firstly, let's get your view on what's taken place on the markets this week and how that's likely to set the tone for next week.
As we've seen this week, the market has been up. The index has continuously been up, though a bit flat. For me, the star of the week has been Safaricom. I've seen it hit the 4 shilling level, something I thought, for me, that's quite a remarkable achievement. Mumias Sugar, again, maintaining its support levels at 6.2. Really, for me, I believe the market has performed satisfactorily.
One might expect, though, as we start out the trading week on Monday, that you're going to have some profit taking on that Safaricom share price.
Of course, yes, I expect it. I don't think, I'm bearish about it, passing the 4 shilling support level. I expect it to stay at that level because you can imagine a lot of guys bought it at 2.90, at 2 shillings 99 at 2 shillings and 90 cents, all the way to 3 shillings and 50 cents. So really, at 4 shillings, I'm taking my profits.
Well, that's what you always see with that share price. You know, it really is traded in between ranges. But let's focus in on Mumias Sugar, because you mentioned the fact that there's strong volumes moving through the share price, up 2.5% today, settling. That's Safaricom share price, but we'll get the Mumias share price up just now. But in the meantime, tell us about your view on the company in light of those results which came through for the full year, and we saw a dip in profits.
For Mumias, for me, the counter was, the results were largely flat. I didn't see much change. But of course, for the investor, looking at the price, it has had value all through the year, coming in from levels of 4 shillings to now 6 shillings and 20 cents. For me, it has been giving results. Then again, if you look at the amount of diversification in that counter, it's marvelous. It's not just exposed to one sector. Remember, they're doing ethanol distillation, ethanol production. They're doing electricity generation. They're adding some electricity into the power grid. They are now moving into water. So for me, it's a counter to watch. I believe it still has more upside. It has more upside than downside for me as an investor.
I mean, one of the counters that we also got our eye on right now is Kenyan Power, because full year results out next week. What expectations are on the table, and what is your outlook for the stock?
For Kenyan Power, for the full year, we've not had much upheavals. Remember, the price of fuel has stagnated at some level. We've not had drought, so I could say power supply has been a bit stable. Really, for me, Kenya Power would be a good buy. If you've seen throughout the year, it has been on an upward trend from levels of 14 shillings 60 cents to now we are looking at. I'm seeing a couple of 17. I'm seeing 16 shillings 50 cents. Yeah, for me, there's still value. There's still more upside. I would settle it. I would be looking to offload at 20 shillings.
Okay, well, there's the range and there's the selling level. When it comes to Kenya Airways, of course, going through this whole restructuring package and then, stripping out huge amounts of cost, 453 employees, choosing to take the retrenchments packages. What are your views on the company now? Because it's still an airline, it's still operating in an environment where oil prices are high, they remain elevated, you've still got so many cost pressures and still competition. So even though it strips out these costs, is profitability going to improve that much?
The aviation sector in Kenya and the East Africa in general is a tricky affair. If you look at airlines, their return on equity is not always that attractive. You might have nice price to earnings value. You might earn, as an investor, the ratios might look good. But the key thing for you as an investor is return on equity. If you're not getting that, then there's no point of investing. Kenya Airways, I would say that their expenses to income ratio has been increasing. Fuel price volatility, employee costs. Remember, a couple of years, I think it was last year, a couple of years back, the employees got a 30% pay rise. Fine, the employees got a 30% pay rise, but is it sustainable for the managing director? Is he able to sustain that and still give still give returns to his shareholders? So I would say that, well, it's sad for the company, but it has to do that so that we can give we can benefit the ultimate beneficiary, who's the investor who puts in money and expect to have a return.
And where the ROE is right now, you're not investing?
It's at the levels that I would not consider it a worthwhile investment. Maybe next year, maybe when you look at, maybe going forward, I would consider it. But right now with the ROE, then with the high cost to income ratio, really, no.
Not at this point, not attractive. Thank you so much,
No.
Crispus, for joining us. Do have a great weekend. Crispus Otieno, dealer at AIB Capital.